Recent figures from the National Bureau of Statistics on foreign trade for the first quarter of 2021 shows that Nigeria recorded 3.94 trillion naira trade deficit in the first 3 months of the year, painting a gloomy macroeconomic condition for the country. This implies a negative balance of trade, as the Nigerian economy is still import-driven and depends largely on exports of petroleum and some agricultural products. To meet foreign exchange earnings, according to the NBS, the country's total merchandise trade stood at 9.76 trillion naira, an increase of 6.99% over the value recorded in Q4 of 2020 and 14.13% compared to Q1 of 2020. The wide margin between imports and exports resulted in a trade deficit of 3.9 trillion naira for Africa's largest economy, making it the highest trade deficit in a quarter since 2011. The wide trade deficit implies that Nigeria is still import-driven and depends largely on exports of petroleum products, such as few agricultural products, such as sesame seeds and raw cocoa, to meet foreign exchange earnings, as this and all are affected the country's currency and push economic indicators to the roof. To make more sense of these figures and, of course, the issues concerning the impact of foreign trade on Nigerian economy, joining me now via Skype, Mr. Ayorinde Akinloye. He's an investment research analyst with United Capital PLC. Thank you very much, Mr. Akinloye. Thank you for your time. Good afternoon.
Thank you, Tolu. Thank you for having me on the show. It's a pleasure to be here again.
Yes, very quickly, with this figure, we see clearly that we still remain import-driven with this balance sheet and these figures coming in. First, how would you react generally to the 3.94 trade deficit? That's for Q1 of 2021.
Okay, yes, clearly the trade deficits, the over 3 trillion deficit that we recorded in Q1 alone, is something quite concerning. Considering the fact that in a COVID year, that was last year where we had the COVID-19 pandemic, basically, we had trade deficit of just about 7 trillion last year. So that's already doing almost like about 50% of what we did the entire year last year, which is a bit concerning. But then we look at the fact that, okay, what were the key drivers? On the export side, we still continue to lag on exports. Exports declined year on year and quarter on quarter. And that was largely also because we had lower crude oil production. As you know, like you mentioned earlier, we are still very much oil dependent in terms of our exports, basically, or crude oil dependence regarding that. So, the fact that we had our production quota, restricted by OPEC, as part of the measures taken to sort of maintain some balance in the crude oil market. So we saw that, sort of impact our exports earnings for Q1. On the import side, imports grew significantly, although we can also attribute to the fact that the Naira was devalued in Q1 also, at the end window to about 4.10. So when you convert our USD imports, compared to what we had last year, where the I&E window rate was at about 360, 365, 366 at this in Q1 last year. So when we compare that, definitely that would further amplify the imports numbers. But at the same time, it's concerning that imports continue to surge. Imports grew by about 54%. Whereas exports are declining. So that's the key thing there is the fact that we continue to remain a consuming economy, and productivity appears to be affected. And again, it shows the vulnerability of the economy and to just crude oil exports alone, and shows that we can't continue to rely on that for in the long run. We would need to diversify our export base in order to ensure that we are not vulnerable to shocks in the crude oil market.
It's a very good way to start. Now let's look at these countries. Asia, led by China, dominated the foreign trade, in the first quarter, followed by the UK, and just like that. I'm looking at African nations standing at about 183.4 billion naira. That's about 2.68%. trade between African countries seems to still be on a very low side. Why is this happening?
Okay, definitely that's due to a number of factors, really. First, to mention the fact that a lot of African economies are commodity exports dependent. So there's really not so much that, for example, Nigeria would want to buy from maybe Cote d'Ivoire, or want to buy from Ghana, or want to buy from other African countries, because most of their products are commodity based, similar to what we have here in Nigeria. So the first thing is the African economies, African countries are not productive enough to produce what we need from each other, basically. So most of the times African countries will definitely have to import from more industrialized economy, who are the ones that process our commodities into finished products. So that's the first thing, lack of productivity or finished goods productivity in most of the African economies. Then the second thing also refers to trade policies. There are still lots of restrictive trade policies in a lot of African countries. And the signing of AFTA is expected to change that. And truly, I think we've had news and information that AFTA is officially kicking in. So that should help sort of improve the policy front and remove some of the trade restrictions that we've had across some of the major markets in the African continent. But again, beyond that, there is need for African countries to improve economic productivity on the aspect of producing finished goods that can be consumed by households and can be consumed by households and further on an industrial level. As long as we continue to remain focused on commodity exports like mining, gold and mineral resources, and energy products like crude oil, we'll definitely continue to rely heavily on exporting to industrialized countries and importing finished goods from these industrialized countries. So there's a need to improve productivity on the aspect of finished goods in African economies.
Improving productivity with regards to goods and services on the African continent is what can help us harness the benefits of AFCFTA, because I was following up with that, a little bit away from just trade deficit. We have the AFCFTA, which according to, in the books, it's already in the workings, and some countries have already started shipments according to what we've heard. How prepared are we to take advantage of this market? I need to ask you this question, because as much as it looks very good, a big market, a lot of money to play around with, businesses and opportunities, but are we set, even as a country, to take advantage of it? We've been having meetings and meetings. What should be the concerns at the moment?
Well, clearly, first to answer the question around are we prepared, I think clearly we are not. We're not prepared to take or take advantage of the opportunity we have in terms of this regional trade agreement. And it's not far from a point that I've mentioned earlier on the fact that we still lack a lot of productivity on the aspect of producing finished goods that can be consumed by households and maybe fairly on an industrial level also. So, for example, you look at our exports, lines, and then you look at the top 15 products that we export, make up 95% of our total exports, basically. And if you look at the crude oil related products, it's about 90% of the total exports. Now, how many African countries, would demand for the volume of crude oil that we produce, maybe because they have refineries and all? No. They don't have that, so we still continue to export to the normal trading partners that we have, the Netherlands, Netherlands, India, and America, and also and Spain also. So on that side, we need to improve, like I mentioned, productivity in terms of making available finished goods. Now, how do we go about this? The first thing is agriculture. Agriculture is one thing, Nigeria can be the food basket of the African continent by taking advantage of the AFTA agreement. Basically, we have the although agriculture is becoming more capital intensive than labor, but there's still a bit of labor intensive need in agriculture. We have the labor, we have, the land, and we have the, the favorable weather to ensure that we're able to produce quite a number of food and cash crops that we can export to some of our African neighbors. And considering the position that we occupy as, a major, or, more or less the giant of Africa, as we typically call Nigeria, we have a very big position where we can use that to our advantage to bargain for deals with so many of all these countries under the AFTA agreement. And if we are able to, basically improve the agricultural value chain, a lot of discussion, the discussion around the agricultural value chain is a different topic entirely. But if we're able to improve the value chain in terms of our storage capacities, our transport capacities, because most of the farms are located in the north, and the main port for export is located down in the south. Now, how easy is it for a farmer to get products from the north and bring them down to the ports in Apapa here in Lagos to be able to export to other countries? Those are the things that needs to be resolved. We need to work on the infrastructure within the agricultural value chain. We take it to the power sector, for example. Yes, currently we supply some neighboring countries electricity, but how about if we work on the power sector such that we're able to supply enough power to Nigeria, and at the same time we're still able to even export to other African countries? In terms of petroleum products, what if, with the Dangote refinery coming on, if we're able to bring more refineries on board, and we're able to refine crude oil to produce petrol, to produce diesel, kerosene, and other major gases that are also needed, and we're also exporting to all these other African countries. So these are key things we need to do beyond just producing crude oil. We need to be able to refine to make them useful to other African neighboring countries, basically, because that is what they can buy from us. So basically, we need to increase level of industrialization, and the improving industrialization ties into infrastructural development and also ties into improving productivity in terms of producing goods that can be consumed, consumables, rather than producing raw materials that still need to be processed, because our African neighbors don't necessarily have the capacity to produce or to process these raw materials. Rather, what they want is finished goods that we can export to them. So we need to build our infrastructure and build our production system to be able to produce these goods, and then we can take advantage of the AFTA agreement. Otherwise, Nigeria will just be seen as an attractive market that other African countries who are able to, attract foreign investments, they see Nigeria as a big market, and then under AFTA they can take advantage of that to sort of, push out some of those goods to the Nigerian market, which will not be totally harnessing the benefit of the AFTA deal for Nigeria.
We talk about diversification of our economy, and I see solid minerals in Q1 standing at 49.5 billion naira. I want to just ask, how well are we doing with the solid mineral in that space at the moment? Because many times we talk more about crude and oil and gas. Now, are we faring better than we used to do in the solid mineral space?
Well, there's been lots of, noise around the sector in recent times as part of the whole story around diversifying the economy, but it's been very difficult to point to anything tangible in terms of growth in that space. Clearly, there are still lots of policies that need to be put in place from an institutional point of view to be able to allow investors harness the huge potentials that we have in mining. So, like I mentioned earlier, this is another sector that we can take advantage of in terms of improving productivity and producing more, and taking our diversifying our export base away from crude oil, basically. I mentioned agriculture the other time. I mentioned, taking advantage of power. I mentioned, refining crude oil, and, another option, like you mentioned, is the mining sector, and we are yet to make any decent progress on that. We still have lots of issues around licensing, around bureaucracies, within government authorities in terms of approval of license, in terms of, getting investments approved, because all these things have continued to keep investors away from exploring the opportunities that we have and the potentials we have in this space. Another key thing also is the infrastructure around this sector. The infrastructure around this sector is also a big problem that will most likely only be solved by private investments coming into that space. So clearly, there's a need for a policy framework to be developed around the mining sector, and with the policy framework coming on board, it makes the sector much more attractive for investors. It makes it the operating environment more friendly for foreign investors to be able to come in, not even necessarily foreign investors, but private investors generally, to be able to invest funds and harness the potentials that we have in the mining sector. And again, that would contribute significantly to our export abilities and export potential, further diversifying away from the crude oil exports. But as things stand, there's still not so much progress, on that front.
All right, wrapping up this segment of the show, we've seen the World Bank and IMF revisiting and reprojecting, talking about growth for the year. As we look at it, vaccination is also on globally, and a little bit of steadiness, let's put it that way, coming to the economy globally. Do you see us reducing our import bills if all things get equal, things get back to normal? Do you see us reducing this? Or aside all of this that we've talked about, we need to promote the agricultural sector, we need to address population issues. What more do we need to do so we can reduce this? Can that help us?
Okay, I think what can be done, definitely we can still do a lot of work in terms of reducing our imports bill. If you look at the top 15 items that we import, for example, it's just about 35% of our total imports, meaning we still import several other items that are typically not even captured in the top 15 items. So there's a lot of work that still needs to be done. And how do we do what is that? What are those things that can be done? Now, lots of agricultural inputs in terms of food and beverage and some manufactured goods are still being imported, in large volumes and, in huge quantities, basically. And truly, we have a very huge market, and consumption will continue to increase and demand will continue to increase. But what we need to do is to be able to ensure that most of these goods that we import, we have the capacity to produce them locally. We try to produce, we should try to improve local capacity or local production capacity in producing these items. Now, that does not mean going on to restrict importing of these items into the country, but rather implement policies and investments make investments to boost local production capacity. When we achieve decent capacity to be able to meet local demand, then we can begin to restrict the importation of some of these items. By doing so, we'll be able to reduce our imports bill. Consumables like rice, household food staples are not items that we should still be importing at the current level where we are in, considering scarcity of forex. So we need to be able to ensure we're able to convert all those items to be produced locally. For example, petroleum products. Petroleum product represents about 10% of our total import bill. If we're able to refine all our petroleum products locally and we're able to supply locally, then that definitely goes a long way in reducing our imports bill further. So that's those are some of the key steps that we can take to reduce the burden on imports. But in the long run, beyond reducing imports, there must be an increased focus on trying to expand our export base, because that will go a long way in improving effects in it and reduce the deficit. We go a long way in ensuring we have sustainable trade surplus over a long period of time.
It's a very good way to live it, Mr. Ayorinde Akinloye. Thank you very much for your time. Investment research analyst from United Capital PLC. I really appreciate this. Enjoy the rest of your day.
Thank you for having me.